Hello, everyone, and welcome back to the channel. This is Fair Value Finder, and today we are taking a look at another requested stock. And this time, it's Dick's Sporting Goods, ticker DKS. Of course, the sporting goods store. They sell a lot of apparel, sports equipment, and they recently had earnings, and they were not too pretty. The stock took a huge drop, and we're going to see if this is a buying opportunity or what's going on. So, I have here some lines of support and resistance. We definitely see that it had a lot of resistance getting above that 130 level, and then again the 150 level. It was right up there, peaked at almost 151 before the huge drop. So things might be able to turn around, and it probably again hit some resistance around that 130, have a touch point or two, and run up until the 150s. Just based on the price action here. It actually wasn't a massive drop if you look at the large scale of things. I mean, it dropped back down to what it was at the very start of the year. The only other time in history that it had really been higher was back in the latter half of 2021, which when we get to the numbers, we'll see why that was. So we can get straight to those because there's not a whole lot else to look at here. And I am torn on this stock. I definitely see the value in it when I'm looking at these numbers, looking at the trends, but I don't love the retail space. There's a lot of shrink going on, which is part of the reason why they're falling so much. And also, the Dick's Sporting Goods here where I live just recently closed down because it wasn't getting enough business, and it's being replaced by an Academy Sports. So that does make me question how other locations are doing. Clearly well enough when we look at the numbers here. But, Peter Lynch would always look around him for stocks to do what the trends are, where people are buying stuff. And clearly, around me, Dick's is not it. But we'll see if I can be converted by the end of this. Revenues, we have decent revenue growth, double digits, but stagnation going forward is what it looks like. Because if we look at the graph here, we see a nice little trend until 2022, and then not a whole lot of movement from then on. It's staying in that $13 billion range. Cost of goods is slowly growing, so it looks like things are improving, though. And then when we get to the gross net and EBIT, we see gross profits having a nice climb. They peaked in 2021, down a little in 2022. And it's the same story for EBIT and net profit. So operations seem to be running about the same. And when we get into the numbers, we said revenue is pretty good. Stagnation is what it looks like. So iffy on that one. Has been good historically. Expenses as a portion of revenue, we want to see decreasing. I mean, it started almost 96, and then 92, 83.5, 88. So 2021 was really good. 2022 is still down quite a bit from where they stood in 2019. So they are making an effort to drive that down. And we're seeing that down here at the margins. The net profit was 3% all the way up to 8%. It'd be nice to get double digits, but in the retail space, it's a little bit harder. The huge jump in the stock price is probably from earnings. It trades pretty well in line with earnings historically, and we're looking at the stock being $3, $3.24, $3.34, $5.72, and then it jumped to $13.87. This year, it's not going to beat that outlook. They gave a pretty big range. It was like 1133 to 1213 or something along those lines. So we're going more towards the middle of that at 1175, and then analysts are looking at 1260 for the following year. So we are seeing some good growth going on. They are well above where they were in 2021. So that is a good sign there. Earnings yield looks great. I mean, with these huge earnings more recently, we get a nice earnings yield. The share count, they've been a little all over the place with this. They were shrinking shares, buying them back, going into the pandemic, and then all of a sudden they turned around and increased them all the way through last year. And this year they turned around and they've actually bought back a whole bunch. Talked about it in their most recent earnings, and they're down below where they stood back in 2019. So they are on a good buyback trend. So although it doesn't look good over here because it was really only this year that they really started to do it again, we'll still give them the green flag for that. Free cash flow yield, they're not super consistent on their free cash flows. 2.1% to almost 14%, 10.5%, 4.5%, 7.8%. So they're in, I can't even assign what range that they're in really based off that, but we are seeing some growth for the most part. I mean, going from 2% to 7.8% is good. So we'll take that. 7.8% is a pretty good yield too. Last year's 4.5 was okay. It could have been better, but we like to see that, and it's on a pretty good growth trend. Assets, they have been good at growing their assets, 10.7% year over year, 7.7% more recently. Liabilities, they've been incredibly consistent at growing their liabilities. 9.72% over the last 3 years, last two 9.3%. So more recently, liabilities have been outpacing the assets, which is going to take a toll on the company in the long run. Tangible book value is positive and it is growing. It's a little inconsistent here again. Let's say 1.4 to 2 to 1.7 to 2.2. So a bit of a zigzag there, but trend is upwards. Debt to equity, this is my one area of real concern. They seem to be very heavy on debt. They don't have a whole lot of debt, but well, it's about $6.5 billion by the end of last year. But when we look at some of these other numbers, they're in the tens, multiple digit billion. But with that 6.5, they only had just shy of 9 billion in total assets. So the debt and the assets are pretty close together, which is going to give you a lower shareholders equity, and the debt's going to weigh heavier. So I'd like to see them paying down this debt rather than growing it. They've just very consistently grown it up through 2021, kind of started paying it back down last year. We'll see what the trend comes back in this year. But at 2.5, that's high, and that's really jacking up the ROE as well, 41.3%. But when you have a debt to equity over 1, you really can't believe that number because it's being skewed very badly by that debt. Dividend, they have a good dividend. They rose it big time. They were paying 48 cents, and then all of a sudden this year they started paying $1. So we'll see how that continues going forward. If they can continue at that pace of raising it like 20%, as they've done historically, we'd be looking at an even better dividend this next year. But right now it's yielding 3.58%, which is a pretty high yield. That's pretty good. Historically, it's been in the ones because it had a much lower dividend that they recently jumped. And they have been very good at growing it, as you can see. Share price, if you take these year-end snapshots, the share price isn't doing a lot for me. 2019, it went down into 2020, but everything did. And then ran back up to almost 110 and then 120, and now it's back to 110. So I'd like to see it moving more, especially with a double-digit revenue and huge earnings growth. Like you'd think that it would have moved more in this 2022 number rather than just up $10. And then when we get to the valuations down here, we've got at the end of last year a fair value of $138, which means you'd be looking at getting in potentially with the margin of safety around 118, and then you'd want to reevaluate around 153. This year, 188 with a margin of safety around 160, and you'd want to reevaluate around 208. And then the following year, 204, 137.5, and 225.5. So we'd say that the fair value, if you're looking out for the next few years, would be not bad, around 175 to 177, somewhere in that range, which means if you do believe that they're going to stay on trend and come in off analyst expectations like this, it wouldn't be bad to pick up shares under 150, which is actually the highest that the stock has gone. So I'm seeing in this some similarities to how Target was. And I think that's just how the retail space works. And they were so good at raising their cash flows in the time frame with such a small start. That inconsistency really messes up our equations, but the discounted cash flow is coming up with an insane $300 just off last year's cash flows and the trend that they've given us. So my issues here, inconsistency. There's a lot of zigzagging, but at least the trend is upwards over time for most things. Very high debt that continues to grow, and it almost seems like a market that doesn't believe in it. And my recent experience of a store closing near me. The balance sheet looks good, decent growth, tangible book value kind of stagnant. Liability is growing too, but not as much. Cash flows, very inconsistent, but we've seen this before. 2 in line, drop down. Usually it's 2 in line and then move and 2 in line. Dividends, this is how insane the recent growth was. They were on a nice trend and then it just jumped. And then when we have everything graphed, just to see if there's anything way out of the ordinary, cash flows were insane in 2020 and 2021, came back down in line with everything else. But everything is pretty standard aside from the balance sheet. The balance sheet kind of underperforms the rest of the stock. And you see here, everything's moving up in 2023. Share price is down towards more where the balance sheet lies. So, of course, we're going to want to see that moving back upwards. I do see the value in this stock. I think that there's some potential for it, especially if they can come in as expected to. But with a 2.5 debt to equity ratio in today's inflationary environment and today's interest rates, that's just rough. If they need to refinance stuff, it's going to weigh heavy on them a little bit. But that's what we're looking at for this one. So I'm leaning towards, it's like a strong hold. I see the reasons to buy. I personally would not do it, and I'd want to dig in some more and actually create a thesis for the stock. But if it's something that you've been on the fence about, it might be worth the risk after this recent drop. So I want to thank you guys for watching. Please like if you enjoyed the video, comment if there's any other stocks you want me to look at, and subscribe so you can stay up to date with everything. And I'll catch you next time.